Hi, everyone. I'm Ava Seave, and I'm an adjunct here, and I teach a media strategy class during the first semester, a second-year class. And I'm here today to talk about, with our panelists, innovation and the economy, how to stay competitive in a challenging market. And you all have picked up the bios of our speakers, but they're going to introduce themselves a little bit so that they can sort of summarize where they're coming from for the discussion. And I just want to clarify, when we say challenging, what do we mean, and what do we mean by innovation in a way? So challenging, is a lower market activity or funding challenges, and it's actually, of course, a euphemism for a down market. And we picked this topic because, in general, we think that innovation, by definition, takes more cash and takes more management time. And so, in fact, we believe that innovation will be badly affected by a down market, and we want to find out what our experts here, which are practitioners as well as professors, think about what's going on in the market today. So I'm going to start with Steve Cohen, who's on my right. He's going to introduce himself, and then we'll go this way, and then we'll start with a question.
Thanks, Eva. I'm Steve Cohen. I'm the CEO of a company called Multimedicus, and we produce something called the Child Health Guide. Anybody here have kids or younger siblings under the age of, say, 7 or 8? Well, we publish for neurotic parents, and happily there are a lot of you, or me. I come out of the publishing world both as a publisher on magazines, and of books, and as an author both of magazines and books. And the Child Health Guide, which I started with some Norwegian doctors, and I'll explain why Norwegian doctors in a second, is unique. And it's unique because it is the only family health resource in the world that uses live action video of real kids with real symptoms, real illnesses, real developmental milestones. So you can see that I've practiced my 30-second elevator pitch. That's what we do. We serve parents, we serve payers like insurance companies, and this is my 8th or 9th startup in about 20 years, both inside of companies and for investors.
Okay, Cliff.
I'm Cliff Shaw. I'm entrepreneur in residence here at Columbia. My background is really in business, but I have been teaching here for 15 years now. I started a number of companies, like Steve, probably a dozen over the 40-year period. Most of them in relatively high-tech arenas. My last company was a partnership with Lucent Technologies called GeoVideo, which dealt with high-definition television over fiber optic networks. But on the other side of the coin, I've been in the health club business and some really nuts and bolts thing. And my passion is for new ideas and developing new companies. So.
And you are the professor of the Greenhouse.
Yes, I am. I'm the faculty director of the Greenhouse program. I actually started it here. Some of you are aware of the program. But we have a focus here at Columbia now over the past few years to really make it possible for students upon graduation to launch companies. And that's my focus here.
Thank you. Len?
Hi. My name's Leonard Silk. I started out, interestingly enough, where you are right now. I was a MBA student at Columbia. But one of the differences between my experience when I left Columbia and many others is 2 weeks after I graduated from Columbia, I was driving a forklift. I didn't go into big industry. I didn't take a lot of the skills that I had learned and directly apply them. They were in my memory bank, and I was a classic entrepreneur. I decided I wanted to be in business myself, and I started out that way. Was in a couple different manufacturing ventures. Ultimately ended up in a company that I started with a friend of mine that was in the housing supply business. Now, as anybody might know and understand, in a recession, probably the 2 worst places to be are wherever you're delivering a high-ticket item, like housing and maybe automobiles and so forth. If there's one place worse to be than in those 2, it's to be a supplier to one of those 2 people, because you feel their pain plus. I did that for a number of years. I am really happy to be here on this panel because I enjoy teaching other people from my experiences. I have been through 4 recessions. I would say each recession was worse and affected me less because I learned well from the pain that I had sustained from each prior recession. One of the things that I learned was to get out of that industry, which I did about 10 years ago, and got myself into another business. I learned how mortal debt and leverage can be. I know it's typical in business, and it's what you learn here, that you use other people's money.
And we're going to ask you for really specific examples, and so we want you to ask some very specific examples of that as we go forward.
Okay. Well, that's a little history of myself. I did go to Wharton before I went to Columbia. You saw in there, and I don't know. You can ask questions along the way, but I'm most interested in being here because I feel that I'm someone that started out in the ditches, started out as a soldier enlisting in the Army, worked his way up being a general and then retired, and managed to survive in a difficult environment. But you know, it's a risk-reward ratio. You have to pay the price. You learn along the way. As long as you don't make the same mistakes over and over again and you learn from those mistakes, you can be a survivor. And I will answer questions and tell you what are the attributes and the things that I learned that I feel were helpful in causing me to be in a position today where I'm not very much affected by what's going on out there. And I want to tell you, you're in here and you don't know there's a massacre going on out in the real world.
Okay, so we're going to get to that soon. Okay, Morten.
Thank you. So I'm Morten Sorensen. I'm a professor here at the Columbia Business School. So in contrast to these people, I'm the theorist in the crowd, so I don't really have as much practical business experience, but I'm very good with math. So the background I have is I started doing research about entrepreneurial companies and venture capital investments about 10 years ago, and I was in the Bay Area around San Francisco. It was a very exciting time there. And I've been following entrepreneurial company and venture capital investments ever since, going through the swings up and down, both in the Bay Area and California and Chicago and now here in New York.
Great, thank you very much. Okay, so let's get started. First of all, Steve, I want to start with you because you're out there now doing these, trying to get money and trying to do different things.
A long, thin limb, yeah.
A long, thin limb. So how do you know when the thing that you're doing is the right product in the wrong market or the wrong product in the right market? And what tells you that, and what do you do when you find out?
Your customers tell you, Ava. And our customer, I try to talk to customers and prospective customers literally every day. And if any of you don't think this is, being an entrepreneur is much about selling yourself, selling your product, selling to bring on a team, then you're really not cut out to be an entrepreneur. Formally, I think we do a review, and we is often just me, or myself, one of the two people. We do a situation analysis every quarter, whether things are going terrific or not going terrific, and we do it much more frequently as we, when things are bad as they are right now.
Right.
And we try to adapt. Innovation is not just product adaptation, it's marketing adaptation.
Right, and what's a situation review?
I ask a couple questions. Where are we? Why are we there?
Right.
Where can we realistically be? And how the hell are we going to get there? And then that cycle continues.
Okay.
And to really try to step back and be dispassionate about it.
Right, Cliff, does that make sense to you?
Well, some of it makes sense, but I think that when I look at
Well, he makes more money than I do.
Steve, listen. I think that the other side of the coin, or part of it is, and I'm sure we wouldn't disagree, is looking at markets where opportunities are constantly. Taking your skill set, whatever it is, and saying, how can I find new revenue streams? What can I do? And what I find in business is people constantly get into a mindset where they're looking in the mirror. This is the way we did it. This isn't working so well. Let's try to cut costs, or let's try to do. Instead of looking and saying, with what I have as resources and what I have as assets, look at new market opportunities. They're all, I don't care. And Lenny, you sounded so pessimistic over there. I was ready to jump off the building. The world is not coming to an end. There's always opportunity. There's always great opportunity if you pick the markets. And if you look at what's going on right now out there in the marketplace, there are plenty of places to play where there's real growth. Example, Steve and I were chatting before. Healthcare is in a whole arena. It is not going to go away. It's going to change in its model of what we do and how we do it.
But you're talking about completely abandoning or just finding a market where you're
I'm
going
talking
into.
about supplementing. I'm not talking about abandoning. So you look and you say,
Right.
I have this skill set. Who could I partner with? What's going on in a marketplace where I can supplement my current revenue streams that may be declining?
Right.
What can I do as a business person to take advantage of where there are pockets of gold? And
Right.
they're always there.
Right.
Can I respond to that? Because
Yeah,
here's
of course.
a same exact segment. 6 months ago, we were talking with a large human resource company that wanted to license our product and give it to the employees of the firms that they covered. They do a lot of back-end human resource stuff. And they were going to pay us literally pennies per month per employee. And that was a very big number for us. It was a mid-seven-figure number for the rights to do that. And market changed. They don't call, you don't write for almost 4 months. And I'm trying to get through to them. They finally get back to me last week. And they said, well, we fired half the people. We don't have the money to invest. But could we co-market with you the product you have to the end user? And we'll take the marketing risk, and we'll share in some of the revenue. And it completely changed our immediate strategy with them, but we're doing it. And it's adapting to the marketplace. Same product, different application
Okay.
in how to get there.
Okay. Now, Lenny, you did talk about how you abandoned certain businesses when you realized that it was really a bad situation. But you were in housing for a long time, right? In various aspects of
Yeah,
it.
I didn't abandon certain businesses. I realized that I was in an industry that was doing very well,
Yeah.
but when the situation changed, when the market changed, we had drastic consequences. And I kept preparing myself for the next drastic consequence because I knew it would come.
Can you give us a specific example of like the product or service you were doing and then how you prepared yourself?
Shelter Systems, which is the company that I started, became the largest producer of component-type manufactured housing in the country, probably the world. We were turning out 50, 60 houses a day, selling most of those houses to builders. I don't care how good your business is, if your customer fails, your business fails.
Right.
It goes away, and in every bad situation, if you search long enough, search deep enough, you can find something good out of it. And it's how you do that. In other words, the building industry didn't go away. The building industry just shrunk tremendously. Now, there's a couple ways you can deal with that. You can take your share of a shrunken market, or you can try and increase your share of that smaller market. And survival is the most important thing, because the good thing that comes out of a recession is if you're a business person and you survive, you don't have very much competition left.
So in this last recession before you sold the business, is that what you did? Did you try to take market share out or purchase or take the assets from your competitors?
I did, and it was a very simple way. And I agree, by the way, with the comments that were made earlier. I would just add to it, using a focus group concept, finding out what your customers want. I learned something very interesting about my customers. If you had said to my customers or said to me, what are the 3 most important things that our customers want? They would have said price, price, and price.
Right.
That's all they want. They want lower costs. They want to survive. And we did some focus market testing, and that's what we found out. And then we went and did some blind surveys and did some other type of testing. We found out, you know something? Price wasn't the most important thing to them. The most important thing to them was value. But they were afraid to tell you that they wanted quality and value because then you'd raise the price. So it's important.
So you're saying the anonymous versus the
It's important
first
to
person.
learn
Yeah.
what your customer really wants. And if you want to survive in a down market, communicate with your customer. Find out what's important to your customer. Let your customer guide you where you're going. Don't take your customer where you want to go.
Right.
You go where he wants to take you, and you will increase market share and you'll survive. It's very hard to do well in a down market. But if you can survive, when that market is over, you have a field day for the next 5 or 10 years.
Right.
And that was one of the things that I learned. I mean, the first time through, I did what everybody else would do, which was just beat the bushes and try and buy materials for less, cut labor, cut wages, cut everything, just do everything. Then I learned being smarter is a lot more effective. than doing the same thing everybody else is doing. Do something different better. Don't try and do the same thing better.
Right.
And
So,
that helped us survive.
so to stay out of each other's way. And it's just,
Can I give an example of that too? Because
Sure.
I think that's a very good point.
Right.
I think that part of what you do is you scan the horizon in difficult times, and you look where you can assist in a space in the market that's inefficient. I'll give you an example. Right now, I'm involved with opening emergency rooms. People say, what emergency room? Well, you have a system. We looked at it, and we said, insurance companies don't want to send people to emergency rooms at major hospitals. Of course, the major hospital is going to take every dime they can. That's how they function. And then we said, gee, on weekends, it's really hard if one of your kids gets hurt to get the doctor because he's off playing golf. So what do? So we've opened 3 centers already, which is in between a hospital and a physician's practice. We know medical care is not going to go away. Every insurance company that's been approached has signed up. Because instead of the average bill of $1,200 when you walk in an emergency room, these centers will take $200 and make money at it.
and that's because your cost structure is so different from a hospital?
Well, it's not that not only a cost structure, but your hospital has a whole different criteria for operation, so much more regulation, so much more going on. Where you're as practicing physicians, you have a lot more flexibility. So you look at that, and we looked at that business and said, okay, we're serving a need in a down market. Tremendous. 20% of our GNP in this country now is inching toward medical care. Huge. You look at how our government money is flowing and such, right? So look at those things saying, is there a business I can create, or is there an idea that I can bring to the market that makes it more efficient? I don't care if the market is a down market or an up market. You do that, you got a business. So there's an example of something you look at now and say, okay, this is inefficient. What can I do to make it better? And it's along the lines of what Lenny's saying too, to go to that, touch base with that customer and say, I'm going to improve what's going on here. You got yourself a business.
I can give you specific examples. You're selling a product to a customer. Very often, you know your product better than your customer does. If you can save your customer money, if you can show your customer how to use less of your product, you can make more money on the amount of product you're selling them because he's interested in the throughput. He's interested in what's left for him. And if you engineer it, if you're smarter, if you teach them, and you work with them, they trust you, they depend on you, and they want to deal with you. And that's where the value concept comes in. Sell a better value. Don't sell a cheaper price. And that'll work. Another thing is, if you learn more about your customer's business, you might find out that there's more product you could be selling them that you have the ability to source, you have the ability to deliver, because once you have your foot in the door with a customer, you've got entree. You have an advantage. Use that advantage. If there were 100 customers before the recession and there's 50 or 25 left, try and sell more product to the ones that are left, because that will increase your volume, increase your margins that way. And the other is, put yourself in your customer's shoes. The customer wants to make money, he wants to survive. Anything you can do to help him, and if he believes you helped him, you've got yourself a customer for a long time. And in business, having a loyal customer is the most important thing you can have.
So I want to change gears a little bit here and start talking a bit about the financing of some of these products and these ideas. And I want to turn to you, Morton, about this, because that's your area, of course. And during these periods, you know, we all have investors, and we have to actually tell them stuff, which is always a problem, especially if it's a bad story. So in general, from your experience, how do you deal with your investors during this period? Are you optimistic? Are you pessimistic? And how would you communicate with them?
So I think dealing with investors is always tricky. It's a relationship you have to manage. And what I've seen is that the best strategy is to be realistic when you talk to your investors, because, I mean, they're going to anticipate what you're coming up with. And to sort of take a step back from that, if now we're talking about innovation here, and if you have a business or technology and you're developing that, and that's the product you're working on, so even if there is a downturn right now, the technology and the development phase by itself doesn't necessarily have to be affected by this. In fact, I think you can make an argument that it's easier to develop new technologies now because there is an abundance of computer scientists and engineers out there in the marketplace that you can utilize. Right. So sort of innovation by itself can move forward at the same pace. I think the real concern is if the demands in the markets have changed, so that the customer demand may just no longer be there for the product.
Right, so the people are available when they're available cheaply, but
Exactly.
you're going to sell it to.
Exactly, and
Right.
that sort of goes back to the issues we've touched upon here. How is it that the economy has shifted? And some of the things we have mentioned is that, well, it may be cheaper to develop technology now. I think the cost of labor may also be going down, which kind of goes back to Cliff's point that healthcare is an attractive industry right now because it's human resource intensive,
Right.
and that may be something that is cheaper going forward. So I think as the opportunities may have changed, and if that is the fact, then you have to go back to your investors and talk about that and figure out how to adapt and move forward from there.
Right. So, I mean, when you're talking about related type of products, and the investor, invested in X, but you actually want to take his money and go to Y, how does that go down, especially given the situation that maybe the demand has changed?
Well, I think it depends on how good a case you make that Y is a better path to go down.
Yeah.
And anybody that's sophisticated in the investment world knows how quickly the terrain is shifting.
Yeah.
So they want people to come back and say, I've got a better model, I've got a better place to put your resources. So if nothing else, they'll be positive that you're at least thinking about the situation and looking for other channels. I don't think that'll ever be a negative.
Right. Steve, how's it going with your investors there?
Well, we actually brought in some money recently, which is a good thing. And not quite surprising, but it was from existing investors.
Yeah.
I think the point you've touched on is that I don't know any investors who invest in a business or an idea, or certainly not the numbers. They're investing in the people. And as investors, they know that the market is going to change, opportunities are going to emerge, and a good team, which is what they're investing in, will be able to adapt. And you hear that, and I think it's absolutely true, what investors are looking for.
Right.
And they want to have confidence in the team they're investing in.
Right. And where is money coming from these days? I mean, is it VC? Is there any VC money out there? I mean, I'm on the board of a company that can't borrow money, even though it's cash positive and there's no problems. They just literally can't borrow any more money for acquisitions.
Right, so clearly the money are tight right now.
Right.
And I think when you talk to the investors, what they will say is that they are very concerned about investing in new companies. They're preserving capital because they need to use that to fund their existing portfolio and tide it over. So everybody's anticipating that the runway...
So that they're just sticking with their current customers.
Exactly. So everybody knows that the runway will be longer than we anticipated. We need
Right.
to tide them over for a longer time, and we need to keep our portfolio alive so we can go out and raise the next fund and the next fund. And going back to how you communicate with your investors, I think if you understand the perspective that your investors have, that they are preserving capital and they're trying to cut the burn rates, and you can reassure them that you are conservative and you're also concerned about burn rates, I think that will go over very well. So
Right.
you can meet them halfway and share their concerns
Right.
with cash.
I mean, Len, did you raise money? Did you self-fund while you were doing your businesses?
Well, I feel part of my purpose here is I'm the reality check.
So are you saying that he's lying?
So
I'm
my
telling
question
you
to the theorist.
that
He's our professor. He can't be lying.
his heads are in the clouds. You don't raise money in bad times. It's nice to think that you could raise money and that would answer your problems, but nobody invests into a downturn. And it's very hard. I don't care if it's a VC, it's private investors. If you want to get investors in your business that's doing badly, I hope your parents have money, because nobody else is going to do it. And if they are going to do it...
Parents wasn't one of my categories, but I'll have to put it down.
But people do this for a living. They don't want to invest into something that they don't feel comfortable with. And if you have a recession, if you have an industry that's not looking like it's got great promise, I mean, I would say if you had a business that you had just signed a contract to supply a lot of material to Walmart, you might go out and find somebody, because you could say, look, I've got $1 million order and I don't have the funds to buy the inventory, but I've already got it pre-sold. You know, okay, that's a no-brainer. But in a down market, that's not usually the case. And I would say, well, everybody would hope to be able to go out into the market and raise money. You're going to have a very hard time doing that, because raising money generally is for increasing revenue. And when you increase revenue, maybe 10 cents of every dollar additional revenue, if you're lucky, might fall to the bottom line. If you want to raise money, cut costs. Cut costs drastically, because you know what happens when you cut costs? 100 cents out of every dollar you cut costs goes right to the bottom line. And if you're going to be successful, it's going to be a little bit of everything. but it's going to be very hard to raise money in a down market.
Now, we've got a lot of students who really want to start businesses, even in this down market clip. So I'd like you to respond.
I'm just trying to find something we agree on. That's what I'm trying to do. I'm always fearful of generalizations. You can't raise money. Well, let me tell you, you can raise money if you've got the right idea. The reality of it is you've got to have the right idea and the right structure. There's money out there. I've seen some deals in the last few weeks where there was lots of money involved with them, but they were very targeted, very real, and people understood what the return was.
Can you give us an example of the category?
Yeah. A very, very large financial institution, that's a global company, is in problems. They have real problems and they want to raise capital. So they look in their portfolios and they say, you know, we got these 10 businesses that somewhere along the line we acquired that don't make sense. They don't fit our core. We've got to go back to our base. So looking at deals to buy these companies that are on the periphery of it. The economic logic is so strong that surprisingly the money surfaces very quickly. But you're buying positive cash flow opportunities. So there's money there for things that are solid. We've just raised money for these emergency room centers I talked about.
And that's a new business.
It's a brand new business, right? It's
Where did the money come from?
The money came from private investors, you know, looking and saying this is a good idea. And what's the game plan? It says open 20 of these and a major company is going to come in and buy it. As part of the due diligence, for example, I went up to United Healthcare and I talked to one of the heads of the company. I sat down over dinner. I said, this is what we're trying to do. And he said, you do that, we'll send you all the patients you can get. So it's looking for those pockets that then you can go back to the market and say, there's logic here, it's a good time to move. We can get good deals. We're just raising money for a company that's online medical products. Well, we target the market that says 60-year-old people are now internet savvy. They're coming out of the workforce. They're learning to buy on the internet. As they get older, they're not going to want to get in the cars. And so we're out raising money for that. You look at the logic and say, you're going to ride this crest. You're not going to make a lot of money in the next 6 months, but the investors are there. If we went out to raise money right now to open an automobile dealership, we're going to have a tough time. But if you're looking at the right pocket,
Well, let me ask a question if I may. Let me drill down one part of that. The people who invested in the emergency rooms,
Right.
have they invested in you in the past? Or have they done business with you in the past?
done business with.
They have.
Yeah, and personal relationships are very important. But at the end of the day, at the end of the train, I may like you, Steve, but unless it's a good idea, man, we ain't talking. So I think the reality of it is, if it is a good idea.
We got the door open.
Yeah, and then there's networks of people. There are businesses right now that are doing very well, and they're looking for opportunities, and they're looking to say, how do I supplement my product line? What kind of an alliance can I have? They're wanting that entrepreneur to walk in. They want Steve to walk in and say, I've got this idea, let's work together because I can help you out of the hole. So I don't think I'd slam that vault shut.
You know, you said you were looking for something that we agree on. I agree with you, and you're agreeing with me. We're just not looking at it from the same perspective. I said it's very difficult to raise money in a down market.
Yeah.
I didn't say you can't. And in fact, I used an example where you could. You come up with a better product, you can find investors. Like I said, if you come to somebody and you say, I've got a contract with Walmart, but I can't afford to deliver them, you're going to find investors. But in a down market, and if your business is having a difficult time, it's difficult. I had somebody come to me, a builder who was having a very difficult time, got a great reputation. And he came to me with a participation deal, with a over-the-top return, and gave me all the pro formas and everything. And I looked at it and I said, you know, I don't believe this. But if he believes it, okay, then he should be willing to stand behind it. So I went back to him and I said, instead of an equity participation, I have a better deal for you. I'm going to do a senior subordinated debt. I want it guaranteed. I want my money out first. And I want guarantees. And I want 2/3 the amount of return that you offered me. If you believe in it, this is a better deal for you. I didn't hear back from him. What's that tell you?
Right. So how is that? Is that happening? I mean, that people are trying to get debt rather than equity as part of this alternative. I mean, normally, if you're a person who has the business, you want debt, like you said, because you don't want to give away too much equity.
Well, you
Is the
want
market
debt,
changing?
but you don't want too much debt because that weighs down your cash flows along the way.
Turn off your
So
cell
there is
phone,
some-
by the way.
So he's
Sorry.
calling
That's
you back. Take the debt deal.
He's in there.
He heard you speak. Sorry, Martin. Go right ahead.
That's okay.
So what is the?
No, it's just that deal is unusual because if you have to pay interest, then that will weigh down your balance sheet and your cash flows. And most starting companies don't really have the cash flow to do that. So that would be an unusual deal to take. So I haven't seen a move towards more debt. I think what I have seen goes along with what we have said is that there is money for businesses and for new companies out there if they can deliver a product that's attractive for other businesses in this environment. So now, so Cliff has been talking about the healthcare side. And another example I have, there is a company that started in California called Rivermind Software that just closed a venture capital round last week where they got $7 million. And what they are doing is that they are offering companies that they will manage their telephone side. So they will manage the telephone system and the cell phone system, and they're promising that they can cost their telephone cost by 40% when they take over the management. So it's a company that's been operating for 3 years now, and it's been growing. And I think that's the kind of company that will thrive in this environment because it's a saving for a business and will flow directly to the bottom line. It's not high tech and it's not pie in the sky, but it's a very concrete business proposition that they can offer. So they were able to raise funding also, and I think that's the kind of business that we are moving towards right now.
Right. Now, we've also talked a little bit about suppliers because, of course, you know, as a consultant is my day job, you know, I'm being stretched. So one of my clients, for example, is Tribune Company, which is very exciting because, of course, you know, our invoices are hanging out there, and I'm supporting the Tribune Company, which I find pretty amusing. But what is the deal with suppliers in this down market? I mean, sometimes you can negotiate, which is what they've done for us. They basically keep promising to pay us, and we don't have other business, so we're going ahead and do it. Is there a policy about suppliers? Have you, as a supplier, as a company, how should you treat your suppliers?
I keep promising to pay my bills, yeah.
You do.
But I talk to them, and I explain, this is where we are, you know, we want to keep doing business with you, and just please be patient. And most say okay.
Right.
Some don't, but...
Right. Can you negotiate with them harder, or do they need the money so that they cut you off?
Everybody wants some money, but some are more flexible than others.
Right.
I mean, the best are professional services. I mean, my lawyers know where to reach me. I haven't paid bills in a while.
Right, right, right. So, sorry, then Morton, but
Okay.
Connie,
Well, I'll just give sort of an amusing anecdote for new entrepreneurs, startup entrepreneurs. You'll learn a lot about how to raise debt. You'll learn how to produce a balance sheet. You'll learn how to go to a bank. The cheapest, easiest money that you will get in a business when you're starting up is from your suppliers. And the easiest way I've found to get free cash from suppliers is ask them. You'll find that if you're honest with them, you tell them what you need, people who normally are expected to get paid in 30 days will go for 60 days. They'll go for 90 days. And then I've told people, I said, and if they need a little more incentive, offer them personal guarantees. And the answer I've gotten is they said, oh, we were told never do personal guarantees, never give personal guarantees. That's terrible. I said, you know, if you don't have any assets, personal guarantees don't cost you anything. Once you develop assets, be careful who you personally guarantee.
right.
But your customer, your supplier needs to feel comfortable with you.
Right.
He needs to have confidence in the business. He needs, in the end, to believe that he's going to get paid. And he's in business to sell product too. And if you can convince them, and if they believe in you, and you have the relationship, you can get 90 days from a supplier. 90 days from a supplier is a gift because it's interest-free money. Even if you have to offer your supplier interest on the money.
Right.
That would be the first place I would go to bring cash into a business.
Right.
Ask your suppliers for cooperation.
Right. I'm sorry, I interrupted. Yeah,
No, that's okay. Sort of like an anecdote from the flip side of that equation is that I think in the previous downturn, one of the things that came out was that Nokia was sitting on a large pile of cash in the previous downturn. And what they used that for was that they would help spend that money to support their suppliers, so they would basically give them more favorable term up front and build strategic relationships. So when you're negotiating with suppliers, if you do happen to have money, you can take advantage of that, negotiate better deals if you can promise to pay up front, because suppliers right now are hurting when they have to extend credit to companies that buy
Right.
their products,
Right.
as I'm sure you are experiencing.
Right. Although we're not working for food yet, but we might at some point. What about technology, though? I mean, do technology suppliers extend anything? I mean, I think that would be a very risky risky kind of free money to give? I mean, do you?
We haven't looked in that direction. Maybe we should.
That means bring anything up here. So we've talked about healthcare. What other areas do you think are going to be okay to invest in or to start businesses in this next year to 2 years?
Well, I think any sort of a service business that helps make companies run more efficiently is a great opportunity.
Right.
Of course, whenever you hear the mantra of cost cutting, people cutting, those people were doing something when they were there. What can we identify that they were doing within those companies that we can take over? And Lenny brought up a very good point before about talking to customers. One of the things that I think works very well is you go to your customer base and you ask them, what else can I do to help you be more efficient? And often you're a product supplier, but they'll say, if you could help us with this part on the front end, if you could help us with this part on the back end, that would be of interest. And sometimes just by entering dialogue with them, you can really discover that. So healthcare is a great opportunity right now. Service industry is a great opportunity. I was listening on any of you here at NPR this morning. They were interviewing people that own automobile service stations. The business is up like 50%. Incredible. Why? Because people are keeping their cars. And they would interview these people, and I was saying to myself, there are always those sectors that you can look at. Look for that service side. Look where you can be more efficient. Also look where there's revolutionary change taking place. And I said this before when I was talking to Steve. Most of you have not been through a downturn. Lenny and I are old war horses. We've been kind of through a number of these. But you reflect on what life was like during some of those. When I was your age, I was in a business in 1973. We had the energy crisis. And I had trucks, and I couldn't get them on the road. Couldn't get gasoline for them. In 1981, we had 21% prime rate. 21%. Can you imagine running a business there? But if you look at all these crises that take place, they're always followed by a surge. And you know what that surge is driven by? It's always driven by innovation. Let me give you a couple rapid-fire examples. Coming out of that in the 70s, what happened? All of a sudden, this thing called the personal computer came and revolutionized the economy. Started then when the Apples emerged and the Dell. All of a sudden, you'll explode and say, this is a whole new world. It will employ new people. Following the 80s, if you look at each of these paths, in the 1991, we were in a deep recession in this country, right? What happened in the 90s? Somebody came up with this thing called the internet, which today affected this economy in a way that nothing has ever done before. Now we're on the next stage. What's going to come next? Well, you look and you say, where are these explosive growth opportunities going to take place? And you look for business opportunities there, because they're always there. I had a conversation recently with a major global construction company. And I got in a conversation with them about fuel cell technology. And all of a sudden, I found all these construction guys knew a hell of a lot about fuel cell technology. And I said, well, how come you guys build skyscrapers? You built the Time Warner. How come you know this? And they said, oh, because we're planning to build fuel cell stations. It'll be a $300 billion market over the next decade when we move from the form of technology we have now, putting fuel in a car, to whatever. So we're studying, and it just struck me as saying, you've got to be looking out there. What's going to change? Look what's going to change in energy. If we were sitting here 10 years from now, this will be a different world in energy. Is there a place you can play? Because those things create explosive growth, and that's how we pull ourselves out. So just a vigilance factor.
In terms of preparing for recession, and Lenny, you said that as you've been going through these different downturns in your business, they were deeper, but you were affected less. So maybe you can talk a little bit about how that happened, and then Morton, I want to talk to you about the balance sheet issues and all that in terms of preparing. But what made you be better prepared and feel it less as you went through this?
It was discipline. I resisted the urge to expand beyond my ability to survive if things change. Mm-hmm. And it comes down to a simple matter of debt. It comes down to fixed costs. It comes down to costs that are beyond your control. And you need to manage that. It runs the whole gamut of the business. And you will see people who use other people's money and incur debt will sail by you during good times because they're making money on, other people's money. What happens when the industry changes and things fall off? Uh-huh. You're left with all that debt, you don't have the revenue to cover it, and you lose all the ground you gain. And I would say having the discipline to say it's not the right thing to do at this time because I have to keep thinking further ahead because each recession was like getting burnt. And those wounds didn't heal. And as long as I could remember those wounds and how much they hurt and what I had done to cause them, that's what taught me to be a survivor.
Right.
And I think you have to learn not to be greedy, to be satisfied with the progress you're making, and keep looking to secure your position for the future because things will change. It's just a matter of when. And you know, it's going to change, and everybody is sure that it will never change.
Right.
And it will catch up to you, and you have to just be prudent. And the last prudent move that I made was I got out of the business because I said to myself, frankly, you know, this takes a real toll. I don't sleep well at night. I don't eat well when I have turmoil in an industry. I mean, I had 8 plants across the country and 900 people, and I would swear during bad times, every one of them was not working with me, was working for themselves, and it took a real toll on me. And I said, the only way to get out of this, the only way to buy my freedom is to get out of this.
Right.
And I sold the business so that I could manage my life. And I'd say when you're young.
Well, you were in the business for a long time.
I was in the business for a long time.
Not saying anything about your age.
No, I was in the business for a long time, and I learned each time how to survive better.
Right.
But in the end, I made the decision. I said, do I want to keep doing this?
Right.
Do I have the strength to keep surviving and doing this, or when is enough enough?
Right.
And when is to move into something else? And that's business. That's a cycle. That's what you'll go through. You'll have to learn how to resist the urge to grow when it's beyond your capability, and you'll have to learn when to get out when the getting's good. Because, you know, nobody sells at the top. You can only sell on the way up. And you have to be able to leave go and move on with your life. And that's what I did, and that's, you know, why I'm a survivor.
Right. So tell us about what the practicalities are of the balance sheet when you're busy preparing for, you know, this.
Well, I think we're sort of returning to a time where cash is king more than it has ever been before. So what you want to do is preserve cash flow, make sure you have capital on your balance sheet. And it has a couple of implications. I mean, first of all, I think companies should expect that the growth trajectory is just going to be more slower than what they have anticipated, and the time to get off the ground will be longer. So it will take more capital.
Cash. Right.
Exactly.
Right.
So we should be concerned about the burn rates. We should try to preserve capital as much as we can. And I think it's, if you can take the long perspective, and if you can understand that things will turn around and there will come an upturn, and if you can put yourself in a position where you can survive until that upturn comes by, then you will be in a very good position. So I think right now is just sort of slow down, preserve the capital, try to put you in a position so you're not growing over the next couple of years perhaps, but put you in a position to start growing in 3 or 4 years when the economy starts firing again.
Do you think that people should treat other people's money like their own money? Is that, that doesn't seem to happen too much? Because this is essentially what we're talking about here, you know?
I think it's always a good idea to treat everybody's money as if it's yours, because in the long run, people will catch up with you.
Right.
You know, reputation is so important, and if
Right.
you show integrity with what you do, then
Right.
you'll get people that will come back and
I mean, the thing which is really striking when you read about these cost cuts is that, you know, people say, oh, they just laid off these people and those people, and you think, well, what the hell were they working there in the first place anyway? And it always amazes me that it takes a crisis to make people, you know, sort of like pay attention to it. So
By
again,
the way, it also means sometimes in laying people off, I can't do things that I wish I could do. So it's not as if we were overstaffed. It's not as if we were flush. We just can't do things at the rate or in the direction we hope we would do them.
but you don't think it means that you're just not paying attention to your fixed and you're just...
Well, I'm ADD, so I probably wasn't paying attention anyway. But no,
Too much
no,
information.
no, I don't think so.
And then what do you tell people who are starting out? I mean, these kids who are coming with a greenhouse project, I mean, you still have to have some people that work for you, right, obviously.
It's the greatest time in history to assemble talented people. I've never seen anything like it. You put an ad out there, and they're knocking on your door. And a lot of
Yeah.
people also, as important as money is to them, they want an identity. There are a lot of people out there who have lost their job, who just want that business card to say, I'm doing something during this period. And and I know we ran an ad the other day for something. I was overwhelmed. 400 people applied for a position. The talent of some of those people were mind-boggling. And it was a modest job. But people are trying to work their way through, so it's a great time.
But now you're depressing all these kids because...
Well, but these are the exceptional ones. You got to understand, they're the hirers, not the hirees.
Okay.
You're not gonna hire. But the reality of it is, it is an incredible market out there for technology, for business savvy, and also there are a lot of older people out there now that will not be returning to the labor force, who will be very interested in helping young people, and they can be tapped.
Right. Lenny, sorry.
We're going through a change, but the oldest business principle still exists, which is supply and demand. It's just changing. People are not going to restaurants. That didn't mean they stopped eating. That meant they started going to the supermarket, buying food, and eating at home. People still need a place to live. It didn't mean that they're sitting on, going out on park benches. Unfortunately, there probably are some people. It means they're doubling up. They're going home with their parents. They're doing things. Find out where the market is going when it changes and go where the market is. Don't try and make the market come to you. Right. It's a lot easier to go where the market is.
So let's say we're in a larger company, not a startup as well, and we have innovation that, you've been hired as the biz dev guy. A lot of our students will, in fact, enter corporate life through doing biz dev. And you are given a product that you have to roll out, and this is the economy. So what would you, let's start with you, Steve, because you,
well, I've done this twice, and I did it for Scholastic, and I did it for Time.
And how do you get money out of your corporate parent, and what is the, and what are the challenges, and what are, how would you go about it if you were in it?
The question I always, who are you serving in terms of customers? How are you serving them? And how are you serving them better than the competition? And I think making a rational, compelling, both rational and compelling emotional case to the bosses is very, very important. I once made a presentation for a new business to the then publisher of Time magazine. And I had my numbers lined up, and I had the whole operation set. And he was an old salesman, and I forgot that. And he leaned back in his chair, and he put his feet up in his desk. He said, you're not selling, Steve, and I like to be sold. And, I forgot who my immediate audience was.
Right.
And I had to regroup and go back and sell him. I guess I've launched, 5 or 6 companies inside of large corporations. And each time it's been different, and yet each time it's been the same thing. And it often starts, people say, do you start with the audience, the demographic analysis, or do you start with the editorial vision? And the answer is both. What the driver is, when Forbes magazine launched Egg magazine, nobody here remembers Egg.
They're too young.
They are too young, I know. But, was that a vision of Malcolm Forbes, or was it a result of a demographic analysis to say there is a market here for whom advertisers want to reach? And in that case, it was probably much more an editorial vision. But I think it has to be the combination of the two, and you have to bring that passion along with that analysis to a boss and say, here's the case, and this is why it's worth investing here inside the company. Right. And it doesn't always have to be for an immediate return on investment. The best example I'll give you, I launched Time Television, believe it or not, in 1984. Time had never been on television. It had had the March of Time in movie theaters back in the Second World War, but it had never been on television before. And I pitched it to the publisher and to the editor-in-chief as a promotional vehicle, but as a break-even promotional vehicle, and as a way to keep some of the talent, some of the editorial talent at Time, who were thinking about leaving for these new things like CNN. Mm-hmm. And by having that vehicle inside that wasn't going to make money, but wasn't going to really cost them, but it had a different corporate objective that was clearly identified at the outset, and setting the expectation of management that this was not going to be a big moneymaker, but it wasn't going to lose a lot of money either, but achieve the objectives.
Right.
Made it happen.
Right. And what are the financial metrics now that companies are using? Is it still the same? Is it IRR? Is it, how are people evaluating, making decisions about, products or new services or divisions?
I mean, the metrics are the same. The numbers are just smaller.
Right. So, and do you think that, and therefore they adjust themselves and they're going to invest in these smaller returns, or?
I think, so in terms of if you want to roll out a new product, and
Yeah.
I think the important thing to keep in mind is what is your customer's position, and what is that they care about, and what is their cash flow position, and try to make a compelling case based on that. And you may have to adjust your product or your sales pitch based on that, and you may also have to anticipate a slower sales cycle and a lower growth trajectory. But I think
Right.
that is just the realities of the situation that we're in.
Right. Okay.
I think the metrics have changed somewhat. If you're talking about dealing with banks, banks used to look at your earnings. They looked at the viability of the earnings continuing. They looked at their exposure based on the history. Banks aren't looking at history as much as they used to. They're wanting a greater spread. They feel they have a higher risk, and
Right.
they want to be sold. They want to be sold that what you're going to do is real, makes sense, and that you're not just giving them a story to get money from them. They need to believe in it, and I'm finding the questions are have a lot more common sense than it used to be before. Before it was out of the book. Now it's coming from the brain. And why should I believe that what you're telling me is true? Show me.
Right.
And,
So they're getting smarter because they're getting squeezed, I guess. They have to pay more attention to it.
Yes, you really have. You can't just believe in what you're doing. You have to prove what you're doing. Right now, out in the market, I mean, I'm a LIBOR borrower. I've been for years. That's as good as you get in banking. If you're really good, you can borrow 3/4 of a point above LIBOR. If you're a prime lender, you can borrow a point above LIBOR. You know what the situation is right now if you're a prime lender? 3 points above LIBOR. Same quality, same everything. Banks are in business. They have to protect themselves. Now, there's good news and bad news there. LIBOR used to be 3.5%. When you were a point above LIBOR borrower, you borrowed at 4.5%. Now LIBOR is 0.75%.
Right.
3 points above LIBOR
Same thing.
is less than it was before. But the banks are looking at a cost of money. They're looking at what the risk is. They're seeing what's happening in the market, and they feel like an insurance company. It's like an annuity. I have to get more money for each customer to cover for the ones that aren't going to make it.
Right.
And you have to be a better salesman, and you have to really believe in the product. And it's tougher. It's going to make a better businessman out of everybody.
Right. Okay. Well, thank you. Now, I want to know if people have questions, and you can actually ask about anything that you think we could answer. Yeah. And I guess you should, do they have to stand up at the microphone for the video?
Down to the microphones.
Just because of the audio. Right. So sorry about that. So go ahead, please, and then this gentleman.
Hi, I have a question. I'm curious whether you think it works if you know you want to be an entrepreneur but you don't have an idea yet, or whether you should have an idea before you decide you want to be an entrepreneur.
That's a good question.
I think eating is important. And having that in your soul is terrific. But it helps to have an idea before you go out and start knocking on doors asking for money. But I think it's important in terms of the type of position you do take to pay those bills and to put food and pay the rent.
Right. I mean, if you don't know exactly what you want to do, you need to be close to people who are entrepreneurs who know what they're doing. And one way to do it is to work for a smaller company or to work for people who are starting up with and just, sign on to those ideas. I mean, surely, people's interests change all the time. So you could have some idea now and then get interested in somebody else's idea. But I think if you don't have an idea like you want and you want to eat, you have to hook up with someone who does have a good idea. Go ahead, Lenny.
And I give you the completely opposite answer. When I graduated from Columbia, I got offered a job with IBM, computer research, doing at the time, the airline industry reservation system. I even had an office up in Armonk, New York, and I desperately didn't want to do that. I was an entrepreneur at heart. I wanted to do something, and I had nothing to do. And I just searched around for anything that I could do on my own. That's why I said 2 weeks after I got out of Columbia, I was driving a forklift. I knew I wanted to be an entrepreneur, and I didn't care what I did. I just was willing to work 20 hours a day. I was willing to do whatever it took And it didn't matter what the product was, didn't matter what the service was. All I needed was a product that somebody would buy, that I could make money on, and that I could build because it was just a passion of mine. So I would say if you are passionate about being an entrepreneur, have some confidence in yourself. Go out there in the market, learn. You may take a job with any company at all doing anything, and you may decide you like it and stay with that and build it, or you may find somebody else, or you may run into a friend. If you have a passion to be an entrepreneur, you will find the product in the business that works for you, and it doesn't matter what it is, because there's one common denominator in business. Nobody makes a product in business if you're really a businessman. You only make profits. The product is just a vehicle to get to the profits.
Okay. Oh, sorry, this little, go ahead, you go first.
There's another classic answer to that question from late Jerry Garcia, who said, "Don't quit your day job till your night job pays." Which is where I am now. And still with the day job, but with a great innovative technology idea that is going to create efficiency for large companies, but requires at this point a bit of muscle to get proof of concept and get it out. And so the question is, since how much of this early stage idea, which right now I own 100% of, how much do I give away to build a team?
Ah, that's a good question. Yeah, Cliff, want to?
Yeah, well, first of all, it would depend on your need of that member of the team. So you define first what the critical success factors are. You make sure you give your equity where it fits that need. So it isn't just some friend or this guy has a good idea, might be nice to hang out with. But if you have a specific need within that technology or within the growth of that business, if your core is, if you're exceptional at technology but you're not good at finance, and you make sure if you're going to spend some equity, it's on someone who fills that gap. There is no rule of thumb that anybody can give you saying this is the right combination. For example, if Bill Gates walked in and said, "I want to be your partner," it's going to be a whole different conversation than if it is if an undergraduate walks to you. So you want to look at the person, look at the skill set, and then look for how you can maximize return out of it. Because again, it goes back to the model that, I'd rather have that small piece of the giant pie than the giant piece of that little pie. So that's a negotiation.
Well, the kind of the model that I've started to evolve to is if I was working on a project, there are 3 projects, if I'm working on one for say a year and a half, I would establish a floor and then say what the potential is and say to, for example, a software developer, if I give you your piece, if you're quoting me $40,000 for development to take us from 100,000 to $1 million, then you're kind of getting penalized by giving you your 40 on a valuation of $1 million. So what I did in that case is I divided into 4 layers. I gave him 10,000 at each level, so he got a bit more. But on something that's even less defined, is there some standard floor I could use for an idea that I put some work into and other people are coming into later?
I want to give you a thought, and that is borrow money, invest equity. You understand what I'm saying?
Better.
Okay. You need money in a business, find a way to borrow money. Okay? If you're going to give away equity, invest it with someone who will contribute more back to the business. And that's sort of a broad answer, but I think it will cover a lot of what you're thinking about.
And just sort of like one small comment on that also, if what you need is muscle for heavy lifting right now, muscle is not all that expensive in the market, so you may be able to buy it on a fee base rather than buy it on an equity base, depending again on what your needs are.
Yeah, that makes more sense.
Yeah, if you have great, let's say, managerial skills, but you don't have great sales skills, you might want to bring in a salesperson and make them a partner because you need that as a function of the business. Okay? But, and that would be if you couldn't hire a great salesman. If you could hire them, I'd say borrow the money and hire them. But if you can't hire them, that's where I would put my equity. I wouldn't sell equity just to bring cash into a business.
You got another question? Yeah.
So this is a kind of two-pronged, two-step question, and it kind of touches all of you somewhat. And it relates to the sources of innovation and the cyclicality of the economy. I was wondering whether it's from the data or whether it's from the experience that you might be able to give us some insights in the, you know, when it's a downturn, do you find that more innovation comes from startup companies, or do you find that then it's more the larger companies because they can actually survive, and how that relates to the flow? And then put back to your experience, and how does it relate being an innovator in a small company versus a large company, and the pros and cons?
Well, does anyone have data on that?
I think
Morton?
what the data show is that the companies that do get funded in the downturn seem to do great, but that's also because they're better on average, and if you can survive in the downturn.
Because the ones who disappeared were the ones that weren't as effective or efficient.
Yeah, exactly,
Right.
and also sort of from the investor perspective, the terms are just better in the downturn than in the upturn. So if you can get funded in a downturn, the prospects are not necessarily bad.
I see. Okay. And then in terms of the actual experience, I think. Steve.
I visited one of my old companies recently, last week. I spent 5 hours in meetings. I was there as a board member of an organization. And at the end of the first 2 hours, I said to a colleague, I understand now why I left this company. I was ready to crawl across the table and strangle some of my former colleagues. I mean, there was a sense of arrogance of folks inside the company who thought they really, you know, they knew all truth. Now that didn't, when I was there, keep me from being innovative or turning to people who had the potential to be innovative. But there was a stifling effect of being inside a large company that in retrospect, I could identify much more clearly. So, you know, my temperament was very, you know, is such that I do better in startups. I don't come into turnaround situations. I am happiest starting with a clean sheet of paper and, you know, building a team, working on an idea, coming up with the business and the money to do it, and then turning it over to someone else. And, you know, it's certainly not at the top of the market. Very often it's pretty low down. But I know where my strengths are, which is in the really early stage in the entrepreneurial cycle. So I think you have to sense where you are. It goes back to the question there. You know, who are you and where do you fit in an organization? Where do you feel most comfortable and where do you think you can thrive?
Cliff, you?
Yeah, I think that two thoughts, Tom. One is that if you look at the history of innovation, where explosive growth comes from, I would say in a majority of cases it comes from the small entrepreneur. And there's a tremendous movement in society where the big companies will buy technology.
Right.
Where they'll see it, you know, YouTube is bought by somebody. But if you look at some of these companies, some of these billion-dollar transactions are very, very small companies that were acquired because the big company realized the need to pull that innovation in quickly. So if you look at, historically, you look at the Apples, you look at the Microsofts, you go down that list, they all started with small groups of people that had breakthroughs in some sort of technology. Built from there, all were quickly acquired. So I would say that it is driven by the intellectual entrepreneur who's far more efficient at creating than a big corporation.
Okay. So I know you have one more thing you want to share with the students here.
Well, actually, I tried to prepare myself for this program by, remember how as Jack Parr used to do it? He used to give you the answer, and then you'd figure out what the question was.
Right. These guys don't know who Jack
Yeah,
Parr is.
that's right. Is that a person
Jeopardy,
Jack Parr is?
Jeopardy is close.
I tried to come up with the answers for
Yeah.
what I thought the questions would be. And, you know, we're sitting here as the experience trying to give you the benefit of what we've learned in the real world. I had this little sign I brought up. I don't know if you can all read it. But for those of you who can't, it says, experience is the best teacher, but the tuition is costly.
All right.
You know, you'll learn, you know, a lot of the basics, but you won't learn the realities until you get into business. And, you know, if there was a few minutes before the lecture was over, I had, you know, just a number of points which I think would give you something to think about when you're going forward and going to be entrepreneurs. And I assume that many of you are here thinking of being entrepreneurs. And I don't know if we have the time for me
And I
to
think
do
we're
this.
going. I think we're going to end, but I know a lot of people would like to stay and chat with you afterwards. So.
Okay.
All right. So I want to thank everyone for coming, and we'll stick around a little bit if you want to ask some more questions.
I thought we were going until 2 o'clock.
Thanks, Steve.
You're welcome. Because